All right, guys, so welcome to the, second combo question that I'll be solving for you. Hopefully the first one was helpful, and hopefully this one will be helpful too. And for this one here, right, we're going to have, just as the last one, a bunch of relevant information at first, some extra information right at the bottom here that we're going to get into in a second, and in this one, we're only going to prepare two statements. We're only going to do the statement of comprehensive income, and then we're going to do the statement of retained earnings. Okay? Now, so we're not going to be doing the statement of changes in equity again. However, this income statement here is going to be way more complicated than the one we did in the previous combo question. So that's why, we're going to spend more time in the income statement, and that's why we won't have time to do an extra statement of changes in equity. However, the statement of changes in equity that I covered in the last video basically covers everything that could possibly happen. It's basically as complicated as that statement could get, so there's really no need to jump into doing another one. Okay, so for this one, it's just going to be statement of comprehensive income and statement of retained earnings. Okay, so we have a bunch of relevant information here. It gives us sales returns and allowances, cash collection from credit sales, common shares issued, gain from foreign transaction, interest expense, notes payable, loss from expropriation, stock dividend paid, administrative and selling expenses, cost of goods sold, dividend revenue, and the retained earnings balance as of December 31st, 2014. It also tells us that Software Corporation follows IFRS and has $50,000 common share outstanding, and that the tax rate is 20%. And then we have some extra information here. It says they discontinued the operations for the marketing division. Revenues for the year amounted to $500,000 pre-tax, and the division incurred interest expense of $30,000 of pre-tax, depreciation expense of $210,000 pre-tax, salaries expense of $120,000 pre-tax, and the assets of the department are expected to be sold for $57,000 pre-tax. And they were originally purchased for $99,400 and have accumulated depreciation of $26,000 to date. Okay, so a lot of information and a lot of numbers. Okay, so first step here is to prepare the statement of comprehensive income. So let's do that right now. So of course we always start with our header. We are the Software Corporation, as you can see. So we'll just write that in there. Software Corporation. This is a statement of comprehensive income. And let's look up here. It doesn't give us the date, so we're just going to assume it's for the end of the year. So for the year ended December 31st, 2015. Okay? So simple enough. Here, let's make this a little bit more organized here for you. Change that to unbold it. There we go. Okay? So first step with any income statement is always going to do our revenues first. Okay? So revenues, what we're doing in this revenue section, since it is the multiple step income statement, is we're going to be looking for our operating revenues, things that occur on a day-to-day basis. And this essentially revolves around looking for this thing called net sales. Net sales equals sales minus sales returns and allowances. Okay? Minus sales discounts, of course. Okay? So we're going to be looking for these accounts up top to see if we can plug into the revenue section here. Okay? Let me just fix that. There we go. So what do we got here? Oh, look at that. We have sales of $960,000, and we have sales returns and allowances of $31,000. It appears that we do not have any sales discounts, so it looks like we just won't include that. We'll just include sales, and we'll include sales, returns, and allowances. Okay? Let me just fix this really quick so we're not going to get any red text. All right? So, and let me fix it so that there's no bold. There we go. I will bold the title here though, however. Okay? So yeah, it appears that there's no sales discounts up there, but we do have sales and sales returns and allowances, and we will use that to figure out our net sales. So our sales for the year are $960,000. So we'll just slap that on there, $960,000. And our sales returns and allowances seem to be $31,000. So let's throw that in there, meaning that we will have net sales of the year of $960,000 subtracted by $31,000. Therefore, net sales are $921,000. One thing I want you to see here is look. We have sales returns and allowances. We also have this cash collection from credit sales. You may be wondering what that is, okay? And what it is basically it's just the cash we've gotten from our, credit sales, right? So credit sales usually go to like an accounts receivable, right? And it's basically the cash we've gotten from these credit sales. What I want you to understand is it's a complete curveball that this question is thrown at you. We actually don't need it at all. It does not go on the income statement. In fact, we can just delete it right now, okay? This is something that we do not need on the income statement, okay? All we need is our sales. We do not need our, cash collections from our customers, okay? That is just extra information that is included in the question in an attempt to throw you off, okay? Don't worry about it. And they do that a lot. Like, for example, here, look also. We also have notes payable. Now, notes payable is essentially the same thing as accounts payable. It goes on the balance sheet. Nowhere have you ever seen notes payable go on an income statement or on a statement of retained earnings. It just doesn't. It's there to throw you off. So we can delete that as well. It's irrelevant. We do not need it, okay? I'm just pointing this out to you because I want you to know that it's not uncommon for them to throw in extra information in an attempt to throw you off, okay? These questions are all about curveballs, and I'm just trying to prepare you for that, okay? So we can just get rid of those things. We do not need to pay attention to them, okay? So after the revenues, the next section we always do is our cost of goods sold. Okay, so let's just do that here. Oh wow, did I ever misspell that? Cost of goods sold, okay? And usually it's reported by itself. And as always, cost of goods sold equals beginning inventory, which I'll call BI, plus net purchases minus ending inventory, which I'll call EI, okay? So we're going to look for these accounts up top to see if we can, calculate cost of goods sold. So if we go through here, we have sales returns, blah, 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 blah. If we go through, we can see we don't have beginning inventory. We don't have any net purchases. We don't have ending inventory. But it does give us cost of goods sold. So it looks like we won't be showing the calculation on the statement this time around. We'll just be listing our cost of goods sold as it is of $435,000. Okay, oops, this seems to have gone up. So our cost of goods sold here is going to be a loss, right? Because it's an expense, $435,000. And that should not be bold. Okay, so next step is always going to be our gross profit. Gross profit equals your revenues minus your cost of goods sold. So it's just going to be $921,000 subtracted by $435,000, giving us a gross profit of $486,000. And I'll get rid of that bold for you. Come here. There we go. Next step is going to be our operating expenses. Things like selling expense and administrative expenses. So if we go through their list here, as you can see, we have interest expense. However, this is more of a non-operating expense, which will be included later on in the statement. Look, here we go. Administrative and selling expense. They just have lumped it all together here for us, making it nice and easy. $249,000. So we'll just add that in. Selling and admin expense of $249,000. $249,000. So we have our operating revenues, right? And we have our operating expenses. Now we can go ahead and calculate our income from operating activities, which is going to be our gross profit subtracted by our expenses. So we'll do a little underline here to show we're totaling it up. And we'll do $486,000 subtracted by $249,000, giving us $237,000 worth of income from operating activities. So we have done our operating activities section, and now it's time for our non-operating section. And we'll always start with revenues. So other revenues and gains. All right, let's bold that right there so we can see what it is, nice and clear. Okay, so let's go look for some other, revenues and gains, some non-operating revenues. Common shares issued, not important. Oh, we have this gain on foreign transactions. Now, you may see this and you may see the word gain and then think, oh, it must be a non-operating revenue. But beware, this is actually a trick, okay? This right here is actually a other comprehensive income item. Any gain or loss on foreign transaction is other comprehensive income. So yes, we're going to have an other comprehensive income, section on this income statement, and that is going to be included in that section, okay? So it doesn't actually go in non-operating revenues. It will go in the other comprehensive income section later. It's very important for you guys to know the basics as to what is other comprehensive income and what is not. Okay, but usually in questions, it'll have something like OCI in the title there to let you know. But in this case, it didn't, so it's important to know. Do we have any other kind of non-operating revenue? Interest expense, no. Loss from expropriation, no. Stock dividend, no. Admin and selling expense, no. Cost of goods sold, no. Dividend revenue, though, however, is. And it appears to be the only one there of $45,000. So we'll just add that in. Dividend revenue. Right, and we'll go right here. $45,000. So that seemed to be the only other revenue and gain. So now we'll move on to our other expenses and losses. Okay? So let's look at what we got here. Sales returns, allowances, no, right? Common shares issued, no. Gain on foreign transaction, we just said is OCI. Interest expense, that is one. Interest expense is a non-operating loss of $100,000 is what we had. So, interest expense. And then we'll just go here at $100,000. Oops, $100,000. Let's go see if there's any more. Loss from expropriation net of tax. Now, is that a non-operating expense or is that a other comprehensive income item? And the answer to that is it is actually a non-operating expense. Okay? It's going to be a pain in the butt for you guys at first to figure out what is other comprehensive income and what is, an other gain or loss other gain or revenue or other gain or other expense or loss. It's going to be tough for you to differentiate between the two, but there's a little table in the textbook, I forget what page, and it actually breaks down everything that is other comprehensive income. And there's only, I think, 6 to 8 items there that is. So if you memorize that, it'll be very easy for you to tell the difference between OCI and non-OCI. But in this case, the loss from expropriation is other expenses and losses. So loss from expropriation. But this is the thing. It is recorded here or at net of tax. And this is not good, okay? This is not good at all, okay? All these numbers here, right, since they're not listed at net of tax, we are assuming that they are all pre-tax numbers. Okay, so all these numbers here are pre-tax. And that is because later on in the statement, we are going to have an income tax section where we're going to deduct our income tax, which will be some random number. Okay? So we list all of our, pre-tax items up top, and then we calculate our income tax later on, which means anything above income tax needs to be recorded pre-tax. So, since this loss of expropriation is given to us net of tax, we need to change this number to the pre-tax number. How are we going to do that? We are going to take, or I'll put it on a different line here. We're going to take $34,000 and we're going to multiply it, we're going to divide it by oops, I got the French keyboard on now. We're going to divide it by 1 minus the tax rate. The tax rate is 20%. So it's going to be 1 minus 0.2, or 34,000 divided by 0.8. We do this because we're trying to figure out what the loss from expropriation is before tax, since we're going to calculate income tax later on. Okay, so that's a curveball that they'll throw at you. So in this case, it's actually $42,500 pre-tax. Anything else here for other expenses and losses? It doesn't appear so. We have stock dividends paid. Dividends paid is not an expense. Okay, we include that on the statement of retained earnings. Dividends paid and dividends declared are never put on the income statement. Okay, so ignore that, and everything else here is not an expense at all. So, this is, for example, but that was already included in operating expenses. Cost of goods sold we already used, dividend revenue we already used, and retained earnings is included on the retained earnings statement. So we're good. So we can just total it up and figure out our total other expenses and losses. So we just add up them together. So we'll do $100,000 plus by $42,500, giving us a total loss of $142,500. Okay? So the hardest part about that section right there is, to realize that there's this curveball of giving you some numbers that are net of tax when they should be pre-tax. And you need to know how to calculate those numbers back. Okay, so you know how above here we calculated all of our operating revenues and operating expenses and found our income from operating activities? Well, here we have now our non-operating revenues and our non-operating expenses. Now we're going to figure out our income or loss from non-operating activities. Clearly, our expenses are much larger than our revenues here, so we're going to end up having a loss from non-operating activities. So this loss is going to be $45,000 subtracted by, plus by negative $142,500, giving us a loss from operating activities of $97,500. Okay, so put that in brackets there. Also tidy this up just slightly. So since we have a discontinued operation up here in this extra information, right? Usually what would happen if you didn't have discontinued operation is right here you would record your net income before tax, and then you go ahead and do your income tax expense, and then you go ahead and do your net income. Usually that's what you would do. That's the process you would take. But in this case, right, we have discontinued operations, right? So we're not going to go ahead and then calculate our net income, because we always calculate net income after discontinued operations, okay? So what we're going to do in this case, we're not going to call it net income. We're actually going to call it income from continued operations, okay? The reason we do this is because everything reported here is all the revenues and expenses from all of the operating activities that are current and ongoing. They're continued. And next, what we're going to report is our things that are discontinued. Okay, it's just one of those things you have to memorize. But it's calculated the same way. You're going to take your income from operating activities and subtract by loss from non-operating activities. $237,000 subtracted by $97,500 is going to give us our income from continued operations of $139,500. I should also add that this is a before tax figure, because our next thing we're going to do is calculate our income tax. And our income tax is going to be, our $139,500 times by our income tax, which is 20%. If we do that, our income tax is going to be $27,900, giving us income from continued operations, right, of $139,500 subtracted by $27,900. Therefore, income from continued operations is $111,600. So now the next step here is going to be to do this discontinued operations section. So, I'll start it off on the next page here actually. Discontinued operations. Okay? Now a lot of people struggle with discontinued operations. Hopefully you watched my discontinued operation question video before this, so you'd be familiar with, how I prepare it and how I go about doing these questions, because, I personally think that it's a lot easier than a lot of people make it out to be. Okay? So if you're familiar with the other videos, you'll know that for the discontinued operations section, right, there's always two things we need to record. The first one is either going to be our income or loss from operations, and the second thing is going to be our gain/loss from the sale of assets. Okay, it's always two things we report, right, and we're just going to need to figure out what the numbers are for both of these things. And then the other thing you need to know is both of these are reported net of tax. Okay, so we can already go ahead and fill this in. Okay, so let's go ahead and look at the givens for the discontinued operations section above, and we'll figure out what the income or loss is from the operations. So let's go and look. Discontinued operations for the marketing division, okay? Revenues for the year amounted to $500,000, and the division incurred interest expense of $30,000, depreciation expense of $210,000, and salaries expense of $120,000. Okay? And then the next part here is talking about the assets being sold. So this first part right here is talking about, the operating revenues and the operating expenses. So it doesn't flat out tell us what the net income or net loss is, but it does provide us with revenues and expenses that we can use to calculate our net income or loss for the year. So what is it? I'll do it right here actually. Net income/loss for the year equals revenues, of course, minus expenses. So in this case, it's going to equal, our revenues of $500,000 subtracted by $30,000 worth of interest expense, subtracted by $210,000 worth of depreciation expense, and subtracted by $120,000 worth of salaries expense. Therefore, our net income is going to be $140,000. Okay, so we have a net income of $140,000. So we'll go down to our discontinued operations section here, and we can fill it in right here, $140,000. Okay, and it's actually going to be income, so we'll get rid of this loss here. So it's going to be an income from operations of $140,000. But wait, if we examine this a bit closer, look at this. The revenues are given us pre-tax, and all of these expenses are pre-tax too. But remember, discontinued operations is always recorded net of tax. So it's not actually $140,000. We're going to have to calculate the income tax. We're going to have to make that $140,000 a net of tax figure. And we do so by taking $140,000 and timesing it by 1 minus the tax rate. Tax rate is 20%. Show you it to you right now, 20%. So, $140,000. Now let me just organize it actually first really quick. There we go. $140,000 times by 1 minus the tax rate times by 0.8 is actually going to be $112,000 income from operations net of tax. Okay? So keep in mind, okay, they curveball you, okay? They gave you the revenues and expenses there, but they gave it to you pre-tax. Okay, this is a pre-tax number. You're going to have to make it net of tax. So that's the first part of the discontinued operations section done. Second part, of course, is going to be our gain or loss from the sale of the assets. Okay, so I'll get rid of this right here. So, and that's going to be related to this second sentence here. The assets of the department are expected to be sold for $57,000 pre-tax, and they were originally purchased for $99,400 and have accumulated depreciation of $26,000 to date. So the question isn't telling us flat out what the gain or loss is. We have to calculate it ourselves. Recall that gain or loss equals selling price minus by carrying value. Okay? So our selling price, it tells us our selling price is $57,000. It's our expected one, but whatever, same thing. But we don't have a carrying value. We still don't know what carrying value is. But good thing, we know the calculation for it. And carrying value equals cost of the asset minus accumulated depreciation. Okay? So in this case, we have the cost of the asset, which is $99,400. And then the accumulated depreciation is $26,000. Giving us a carrying value of $73,400. Oops. $73,400. And there's way too many zeros there. So we have a carrying value of $73,400. So now we can go ahead and complete our gain or loss calculation, right? So it's going to be our $57,000 selling price subtracted by our $73,400 carrying value, giving us actually it looks like it's going to be a loss of $16,400. Okay, that is our loss. And that is what we're going to go put on the second part of our discontinued operations section. $16,400. But wait, if we go back up and look, these numbers, again, pre-tax numbers. But everything in discontinued operations is reported net of tax. So really, it's not a loss of $16,400. We have to make that a net of tax figure. How do we do that? Same way we did before for income from operations. We're going to take our $16,400 loss, times it by 1 minus the tax rate. Okay? Let me just organize that really quick. If we do this, we're going to end up getting a loss of net of tax of $13,200. Oops, not in the right spot. And that is how you prepare the discontinued operations section. Oh, that's not even on the same line. Let me fix that really quickly. There we go. And that is how you prepare the discontinued operations section. As you can see, it's pretty simple. You just need to keep wary of that these numbers need to be reported net of tax. Okay, it's the same concept as this loss from expropriation. They'll try to give it to you pre-tax or net tax, and you gotta, make sure that you change it to the appropriate one. Okay, so to finish off this part of the statement, we're just gonna calculate our total, income from discontinued operations. There we go here. Which is going to be $112,000 subtracted by $13,200, giving us $98,800. And from there, now we can finally calculate our net income. Net income is just going to be income from continued operations plus by income from discontinued operations. Net income for the year is going to be $210,400. And you'd think by now we would be done, but unfortunately, we are not. However, we are almost there. The last part, of course, is always our other comprehensive income. Other comprehensive income. So, like I mentioned earlier, we do have an other comprehensive income amount. We actually have this gain on foreign transactions. Okay, so we're going to have to put that in there. But first, of course, we got to remember that in the other comprehensive income section, for some reason, we always start with this random sentence. Items that may be reconciled subsequently to net income or loss. Okay? And let me just make it 2 lines here so it doesn't take up too much space. Change that. There we go. Okay, so now we've added in that random sentence. Now we can add in our actual thing, which was the gain from foreign transaction. And the gain from foreign transaction, once I spell it right here, actually was $23,500. So we'll go throw that in there. Here we go. $23,500. But wait. Again, another curveball has appeared. Look, this number is pre-tax. And the thing about the other comprehensive income section is that this section here is actually reported net of tax. So we have to take this $23,500 and turn it into a net of tax number. How are we going to do that? Well, quite simple. Same way we did for the discontinued operations section. Okay? We're just going to take $23,500 and times it by 1 minus the tax rate, which by now I hope you know is 20% right here, as you can see. So if we do that, then it actually turns out that our gain from foreign transactions net of tax is, let me put it over here, $18,800. Okay? Oops. And that's your other comprehensive income. And that's all there is for it. If we go back up, there's no other, other comprehensive income items here. So the only thing left to do is to calculate our comprehensive income. Comprehensive income equals net income plus other comprehensive income. So $210,400 plus by $18,800 gives us comprehensive income of $229,200. And finally, we are done. Oh wait, we're not. There's actually still one more step. EPS. Remember, oops, I didn't even write that right. Let me put that in there first. Remember, it's IFRS, guys. And IFRS, you may forget, because it takes forever to get to the end of the statement, is you always do EPS. And EPS equals net income divided by weighted average number of common shares. So in this case, our net income is $210,400. And our weighted average number of common shares in the question is given to us is 50,000. So, throw that in there. $210,400 divided by $50,000 gives us our EPS of 4.21. And now we are finally done. Okay, finally we have made it to the end. So this is how you prepare this income statement under IFRS. If it was ASPE, however, you know what to do. There is no EPS. And also, comprehensive income doesn't exist under IFRS. So, in fact, we wouldn't even include the other comprehensive income. We would end it just at net income. And that's what we would do under ASPE. But however, it's IFRS, so we include other comprehensive income and we include EPS. Okay? So that is part A done. And now we'll move on to complete part B, which should be fairly quick. I hope at least, okay? And that is the statement of retained earnings. So, again, we always start with our title. Let me just make some extra space here for us. I'll just do it right here. Okay, so company name, statement kind, statement of retained earnings, and then again the date. Statement of retained earnings always begins with our beginning balance. So beginning balance of retained earnings for, and then I'll put December. Or sorry, it should be January. Since the year ended December 31st, 2015, it obviously started January 1st, 2015. So we'll go up and we'll look for that. It's always a given to us. So right here, retained earnings balance as of December 31st, 2014, $467,000. Now, our beginning balance starts January 1st, 2015, so literally one day after this date, and we're going to assume it to be the same thing, $467,000. Okay, so we'll just add that in. Usually, what we would do next is we would add any correction or adjustments to retained earnings that, maybe we found errors in the past that we would add to the beginning balance to figure out our adjusted beginning balance. But if you look at our givens here, we actually don't have any. There's absolutely no correction for any prior errors. So we don't need to do that. So we can skip that step altogether and move on to just adding and subtracting our adjustments. First one, as always, is to add net income. Okay, so net income is obviously right from our statement of comprehensive income, $210,400. So we'll just throw that in there. Next one, of course, is to subtract any dividends paid or declared during the year. So if we go through all of this, we'll see that there's one thing that stands out. Stock dividends paid, $12,300. So we're going to subtract that on the statement of retained earnings. So stock dividends paid. Remember that if there were stock dividends declared or even cash dividends declared, we would subtract that too. So it's $12,300. And I'll move these over just a bit to give it more space. Total up all these adjustments here on the right. Oops, this is underlined for some reason. Total up all these adjustments to the right. So $210,400 subtracted by $12,300 gives us our total adjustments of $198,100. Last step here is to figure out our ending balance of retained earnings for December 31st, 2015, which is just going to be your beginning balance of $467,000 plus by the total adjustments of $198,100. Therefore, ending balance is $665,100. Okay? Quite clearly, a very short, very easy statement. You just need to know that the net income, is pulled right off of the statement of comprehensive income that we just prepared. And we have to subtract any stock dividends paid or declared during the year. Okay? Which you can find always in your givens. And that is the second combo question. And that is basically all the questions that I will be solving for Chapter 4. Hopefully they'll, assist you and help you, guide you through the practice exercises at the end of the chapter. Hopefully it'll make practice a lot easier for you and will help you on the midterm exam. So good luck to you.